What drove your decision to found Alceon back in 2010?
It was a combination of things, as you're probably aware. It was after not that long after the GFC and after sort of my former life in Babcock and Brown. And Trevor Lowenson was someone that worked with me at at Babcock and Brown. And we'd agreed that if we did anything again, we'd do it together. And Morris Simons, who was the third founder, was a mutual friend and been an investor in things we'd done before. And quite frankly, an opportunity that was almost too good to be true landed on our doorstep. And we took that opportunity, and it became the first transaction that we did together. And then we decided, okay, we'll keep going forward. And we had a couple of people that helped us with that deal and sort of ran a little internal competition to come up with a name, and decided it should start with an A. And someone came up with Alceon, which is, so that's really how it founded. It was really around a single opportunity and a desire amongst the three of us to work together.
And did you see this growth in non-bank lending or the pullback of banks at the time?
No. We started very much on the basis of sort of being not too different to what Babcock and Brown was in the pre-IPO days, which was a small boutique syndicator of investment opportunities. And the last thing I thought I'd be doing would be senior lending. In 2010, the banks were still active, and in fact they were coming back into the market, and my whole career had been around using gearing to generate equity returns, which we did for the first 5 years, and we did some mezzanine debt. And then around 2016, a lot of the market was looking to do mezzanine debt and pushing down the rates, and all of a sudden we started to see the banks pulling out of senior debt, particularly in the Brisbane market. And we could get rates on senior debt that weren't too much less than what some of our competitors were doing mezz at, and it just didn't make any sense to us. That's when we started going into senior debt. And of course, senior debt is a much larger volume business than mezz or equity, especially in the development space. If you look at a $100 million project, there's probably normally $60 million of senior debt and $20 million of mezz and equity, and hopefully $20 million of profit.
And what are some of the most common misconceptions about investments in private debt or private credit?
I think initially there was a lot of misconception about risk.
Yeah.
There's a sense that private credit's riskier than equity.
Like the higher income seems higher risk to some people, where it can actually be.
Well, it's always lower. On any single deal, there's always lower risk than the equity.
Yeah.
You get the money back first.
Yeah.
So it can't generally be higher risk than equity, and that applies on a portfolio basis. The reality is that some of the returns that were available concerned people in terms of the risk. They thought, if I'm getting this return, it must be risky. People aren't, what they're saying is not right or whatever. But today, with the rise in interest rates, you can get double-digit returns lending on the same basis that the banks traditionally lent on property development, which is 75 to 80% of cost and 60% to 65% loan to value. Some pre-sales if it's a residential project, or committed income streams, and those opportunities are available. And why the banks aren't taking them, it's partly APRA rules, and now that they've stopped doing it, it's also resources, because all the people have left the banks that have had any experience in doing it.
And what do you see as the most compelling attribute for financial advisors or investors going into the sector?
I think return for risk.
Yeah.
It's absolutely compelling. I mean, I've been doing this stuff for 30 odd years, and the premium that you're getting on senior debt today is the best return for risk, pretty much, certainly since the opportunities that existed on equity in the mid-90s after the downturn in the early 90s and the recession we had to have. Australia emerged out of that very slowly, and interest rates declined slowly. And there were some amazing opportunities in those days when you could get leverage from banks. But in terms of, for the average guy in the street that's got a little bit of money to invest, senior debt, as long as they're not seeing it as a cash management opportunity, right? The one risk in senior debt is liquidity, and it's there today in spades because of all this supply chain delays and all of the other delays that the market is encountering. Your loan won't necessarily be paid or mature on the day you expect it, but your interest is still compounding and still there, and as long as you've got that equity coverage and you're lending at 60%, you'll get your capital and your interest. You might just get it 3 months later or 6 months later, and you'll have earned interest in that 6 months. So.
We're seeing a lot of volatility or uncertainty around the economic cycle, maybe more than in the past. Are there any similarities to this in previous cycles that you see, whether it's in property or more broadly?
There are similarities clearly in the 70s is a bit before my time, still at university, but the 80s and including the sort of early 90s where interest rates were up at higher levels than they are today. There was still inflation around, and it was a while before interest rates came down. The property market took a beating. I think Australia didn't have the same international exposure. There's a lot of reasons why I don't think the market will be anywhere near as bad as that, and we're seeing it now. There may be a little more, it may get a bit worse than it is now, depending on how far the Reserve Bank has to go or feels they have to go. But there's definitely similarities and there's differences. But
Which sectors of the economy are seeing the best opportunities at the moment?
In property, look, I still think industrial is, there's massive undersupply in the way the markets are moving. At these interest rates, hard to justify the sort of 3% cap rates that institutions were buying property at, buying industrial property at 12 months ago. But I think there's really strong underlying demand. I think medium term, I don't think anyone argues with the fact that the residential market is going to be undersupplied, given the demand for overseas skilled workers, students coming back, and we're seeing it in rents. We're seeing it in the drop-off in construction. If you build in some correction in prices and interest rates peaking and starting to fall, and population growth of 200,000 or so a year, then the medium-term outlook for residential is phenomenal.
Phil Green, thank you.